Welcome to today's market report.
European stocks struggled on Monday after their worst weekly showing since February, hit by a growing number of risks, including signs of inflation, elevated bond yields, and developer China Grande's financial troubles. The Pan-European Stoxx 600 index fell for a third straight session, down 0.5%, holding near 11-week lows hit in last week's sell-off. A move into the black during the session on the materials stocks rally was outweighed towards close as falls in technology stocks intensified after peers on Wall Street were pressured by an uptick in treasury yields. Banks and luxury goods also lost on fears of a slowdown in global growth as China, the world's second largest economy, deals with fresh COVID-19 restrictions, a property sector slowdown, and regulatory clampdowns. French luxury goods makers Kering and LVMH, which draw a major portion of their revenue from China, fell 1.3% and 1.4% respectively. Investors should brace for more stock market volatility throughout October, which is also a seasonally turbulent time for stocks, as worries about inflation, supply chain issues, China and the US Federal Reserve policy are still with us, Chief Executive of investor firm Zega Financial said. A survey showed investor morale in the Eurozone fell to its lowest level since April in October on dimming economic expectations. Stoxx 600 has dropped about 5% from a record high hit in August due to signs of slowing growth and inflation. Bank of America Global Research last week predicted a nearly 10% drop by year-end, given a shift in the macro backdrop towards anti-Goldilocks. Morrison's dropped 3.57% after US private equity firm Clayton, Billider and Rice won the auction for the British supermarket group with a £7 billion bid. Rivals Tesco and Sainsbury gained 1.5% and 3.4% respectively, and along with a rally in oil stocks, helped UK's FTSE 100 cap losses. UK telecoms group BT Group fell 4.7% after media reports said Sky was closing in on a broadband investment deal with Virgin Media O2, which analysts at Jefferies said could threaten BT's Openreach. Crude oil WTI was up 2.28% at $77.61 per barrel. Brent was down 0.02% at $81.28 per barrel. Gold futures was up 0.69% at $1,770.50. On the FX front, the GBP/USD is climbing for the third consecutive day, trimming some of the last week's losses, trading at 136.13, up almost 0.5%. The market sentiment is downbeat, and risk flows to safe haven assets boosted the Swiss franc, leaving the US dollar behind. Evergrande's worries dent investor sentiment. Further inflationary pressures, energy crisis, and US debt ceiling concerns keep traders on the sidelines. The dollar index was down 0.3%, sitting at 93.79, whereas the US 10-year Treasury yield is up to 2 basis points, currently at 1.484%, below 1.5% for the second consecutive day. There was no macroeconomic news featured in the UK. The US Census Bureau released the factory orders, however, for August, which increased by 1.2%, better than the 0.9% foreseen by economists. The report failed to boost the dollar as traders await the US non-farm payrolls report unveiled on Friday. The pound pushed above 136 could open the door for further gains, but a daily close above the latter is required. In case of that outcome, the first resistance level would be the 24th of September low at 136.57. A breach of that level could push the pair towards key supply levels like the figure at 137 and the 500-day moving average at 137.62. Failure at 136 would exert additional downward pressure on the GBP/USD pair. The first demand zone would be the July 20th low at 135.71. A break of the level could expose 135, followed by the October 1st low at 134.33. The euro has opened the week on a moderately positive tone against the dollar and extended its rebound from 14-month lows at 115.60.
This is today's market news. Thanks for listening. We'll see you next time.